The economic growth of China has seen an increase in its demand for capital, fueling the local stock market. The integration of Hong Kong brings with it access to capital and trading expertise. It is against this backdrop that on November 17, 2014, the Shanghai Stock Exchange and the Hong Kong Stock Exchange introduced the much-anticipated Shanghai-Hong Kong Connect, a bilateral investment channel between the two markets. The Connect channel allows for mutual market access, such that investors in each market can trade in the other using existing trading infrastructure. Eligible stocks to be Connect traded are constituent stocks of major market indices. There are approximately 560 Shanghai stocks and 260 Hong Kong stocks that have been Connect traded since November. Recalling that the job of the regulator in each jurisdiction is to ensure that market design changes, such as this, face and pass the dual tests of fairness and efficiency collectively referred to as market quality, the question we need to ask is, in the wake of this change, was market quality affected? Using the market quality dashboard, we can answer this question. We have created two groups of securities, namely connected securities, available to Chinese and Hong Kong-based investors, and excluded Connect securities, which are only available to domestic investors. We have also created another group for the dual-listed securities between the two markets. Selecting these securities under the Groups tab within MQD and a 6-month event window around November 17, 2014, we can verify the launch of the Connect channel by ticking Show Events. To examine how the bilateral investment channel has affected trading behaviour, we first examine for the Shanghai market the on-market trade volume metric. Here we see that the introduction of the Connect channel has substantially increased the level of trading for the group of cross-traded stocks from around 15 billion to at one point reaching 67 billion. The increase in trade volume on the Shanghai market has been permanent, with trade volume in Connect and dual-listed securities almost doubling over the event window. As expected, we do not observe a noticeable change in volume for non-connected securities, as these securities remained restricted to foreign investors. Turning to measures of market efficiency, we observe that in Shanghai, effective BidAsk Spreads declined. However, we observe this significant structural change at a much later date, around mid-December. A second measure of market efficiency which we examine is intraday volatility. Here we see a rise in volatility for the Shanghai market following the introduction of Stock Connect. However, if we overlay the number of transactions, we also find a corresponding increase. Given the well-established relation in the literature between the number of transactions and volatility, we conclude that the introduction of Connect for the Shanghai market has led to a substantial increase in trade volume with no detrimental impact to market efficiency on the whole. In terms of market fairness, one variable we can observe via the MQD is information leakage. As the figure demonstrates, market fairness does not appear to have been impacted in Shanghai post-November 2014. Replicating the same analysis above for the Hong Kong market, we find an initial increase in trade volume, which then appears to revert to pre-Connect levels. The difference in impact on trade volume across the two markets is likely to arise from the disparity in access conditions between the two markets. While the Shanghai market was open to all Hong Kong market participants, or anyone who could open a trading account with a Hong Kong-based broker, mainland Chinese investors wanting to trade in Hong Kong had to qualify to trade by demonstrating a minimum of 500,000 RMB in investment in cash, possibly limiting the number of investors able to qualify and hence trade. In terms of BidAsk Spreads on the Hong Kong market, we observe a similar structural decline in December, even for the non-connected securities. If we hide these from the chart, we can more clearly see the significant decline in BidAsk Spreads for dual and Connect securities in Hong Kong. This result, as is possibly the case for China, may be a function of several factors, two of which I will highlight. One, the introduction of new market makers in each venue may have caused spreads to decline following the introduction of Connect. Or two, evidence of commonality in liquidity, where if one security's liquidity improves, so too does that of other correlated securities. Turning to volatility in the Hong Kong market, we see an initial increase. However, this appears to be short-lived. In terms of market fairness, proxied by information leakage, except for the large one-day increase, which is associated with an increase in volatility and also trade count, there appears to be no change in the Hong Kong market. In summary, we provide prima facie evidence that the Connect channel has attracted new market participants, particularly for China, and that transaction costs have been reduced in both markets. While short-term volatility may have increased, possibly due to speculative trading, we see no change in market fairness. Overall, we conclude that the Connect channel has been a positive for the two markets.